What's going on, guys? In this episode of Should I Invest, we're going to be talking about the thing everyone is talking about, and that's AI, but most specifically the AI stock, which is recently broken out of a serious consolidation and is just taking off with volume. All right, so with that said, we have our handy dandy amazing MarketSmith tool here that's going to give us all the information we want to understand whether this is something we want to invest in the long term. And we also have the Yahoo Finance as well as this handy dandy Excel sheet that I've designed to help with this. All right, if you guys want to use MarketSmith, the link is in the description, and they are running a promotion, which is a great tool, and I think you guys should have it if you're serious about investing. All right, so with that said, let's go ahead and plug in the information here. We got AI, and right off the bat we can see that it's got a negative EPS. So when we got a negative EPS, PE and return on equity is actually not going to be great, but we'll double check. So PE is not available and return on equity is also not available. All right, perfect. So now the next thing we need to look at is total debt to total asset ratio. So we have our Yahoo Finance here, and we have our Excel sheet. So let's look at total debt to total asset ratio. Okay, so we're going to go to balance sheet. We're going to look at total debt, which is right here. We're going to plug that right there, and we're going to look at total assets. All right, and we're going to plug that right there. So we can see that our total assets actually can pay off our total debts over 6 times. The only other company that we've researched that's been able to do that was Shopify, all right, which is a great thing. Now let's look at current debt and current asset, all right. So when we do that, we're going to look here, right here on current liabilities. We're going to plug that right here, and we're going to look at current assets. And to do that, we're going to come here and look at total current assets. All right, so we got that. We're going to plug that right here. And we can see that just based on these numbers alone, we have a total debt to asset ratio, or current debt to asset ratio of 7, which means we can pay off our debt 7 times over and over again. All right, so next thing we need to look at is operating income. So let's look at the income statement and see the total operating income. So total operating income here is a negative number, so they're operating at a loss right now. Now let's look at the total revenue. So total revenue is 266. All right, so we're going to plug that in as well, and this number is the problem here. All right, we got a total revenue and their operating income is less than what they're actually generating, which causes the problems in the EPS. All right, now next thing we can look at is cash flow. So let's go ahead, look at cash flow. Minus 41, minus 60, minus 39, minus 90, and minus 218. So by the looks of it, it does look like it's decreasing. All right, now owned by management, we come here to the left, we can see management owns 29%, a little bit aggressive here. Probably the biggest number with all the stocks that we've researched. Management owns 29%, so they're really putting their money where their mouth is. All right. So next thing we got to see is the fund ownership. Okay, is the fund increasing or decreasing? And we're going to do that. We're going to come to MarketSmith, look right here on the fund ownership summary. We can see from March 2021, they have slowly increased, but we've kind of stalled here, right? They've kind of loaded up, and they're kind of just waiting for something to take place. So overall, the fund is increasing. Now, the Excel sheet is going to give you a fail. All right, now what does that mean? Does that mean this is a horrific stock to invest in? No, it just means it hasn't generated profits yet, so the numbers are actually a little bit skewed to the wrong side. All right, if you understand what this is, and if you understand what it is that they do, and you have to treat this as a higher risk, essentially growth thing, all right, because they haven't turned a profit because of all the other things that we just discussed. You know, the balance sheet, the operating income, the revenues. It's a little bit of a higher risk to put 90% of your account into it. So you want to balance and, you know, assign money to certain stocks and certain things at different areas. So for example, you know, your good fundamentally sound stocks, you want to probably have some more money in those versus these higher risk ones. You want to have, you know, a smaller percentage because they're obviously more volatile, 1, and 2, their future is really unknown essentially. All right, so with that said, I hope you guys did find value in this nice little quick research to bring some information and open your eyes about what's really going on these companies that may be running, you know, at days at a time, and for you to really pay attention to the fundamentals fundamentals before you say, hey, I'm going to buy this for the long term. All right. If you guys found value in this, go ahead, subscribe, comment, and like. Comment down below what stock you want me to do next, and I will more than happy do it for you. Thank you for watching, and we'll catch you on the next one.